We shall now begin. I hope the rice doesn't kick in right now and you stay awake and glued. So let's begin with our next session, and that's going to be Indian financing institutions. Are they adequate to support 8% GDP growth? And for this, I'm going to call our moderator, Mr. Tamal Bandyopadhyay. He's an award-winning author and consultant, and he's going to moderate this session. Can we have a round of applause, ladies and gentlemen, as I invite our panelists. He's an Indian business journalist known for his weekly columns on banking and finance, Bankers Trust. He has authored 5 books, and he will be moderating this session. Joining him is Ramesh, Iyer, the Vice Chairman and MD, Mahindra & Mahindra Financial Services Limited. He is responsible to drive inclusive growth and instrumental in building Mahindra Finance since 1994 into one of India's leading rural finance companies. Mr. Nilesh, MD, Kotak Mahindra Asset Management Company Limited. He has led his team to the Best Fund House of the Year award at all the mutual funds he has worked. We also have Mr. Jairam, Sridharan, MD, Piramal Capital and Housing Finance Limited. He has over 2 decades of rich domain experience and specializes in setting up and scaling new businesses. We also joined by Mr. Ajay Kanwal, MD and CEO of Jana Small Finance Bank. He's a senior consumer and commercial banker with 27 years of experience across Asia. We also have Krishnan, Sitaraman, Senior Director and Deputy Chief Ratings Officer, CRISIL Ratings, who started his journey in the year 2000, and since then he has held various positions at the firm. And ladies and gentlemen, let's give our panelists a huge round of applause. And here we go, Tamalji, all yours.
Thank you, and very warm welcome, very good afternoon. I think I must congratulate Trust for crafting this panel, because you have everybody, 360-degree view of Indian economy, what's happening in India. They can say we have from market, we have from banking, we have from non-banking, we have rating agency. I'll not waste time in introducing them. She has already done it. The challenge is how to keep you awake post hearty lunch. And also Nilesh told me that you can ask anything you want, but we have the answer. So you know. So how to get the best out of them, I don't know. He was very frank just the last 2 minutes over, I think, some halwa and rasmalai. Being a Bengali, I was savoring, and he said, you can ask any question, but answer we know. Oh, that answer you cannot influence. So with that background, let's start. And for the audience, not to keep you awake, that is what we have decided, even had it been even any other session. Feel free to take questions. We will not wait till the end. Okay, in between anything you interesting, just make it very, very short. Just the question, no observation, please. Just introduce yourself and who are you asking. We are running little behind, 15 minutes behind, so we'll cut the 60-minute session to 55 minutes probably, and that's how we'll go ahead. And after that, there is some unveiling of some volume, etc. there, that the organization will take care of it. So with that, let's start. Indian economy, everybody talking about the brightest spot that we have now the world 5th largest economy. Recently, Financial Times said that we will be the 3rd largest, and it also gave the idea how our GDP would grow, doubled in next few years. And one of the things the banks people say, the proxy for economy, if you see the September quarter result, this is the best quarterly result for the banking industry. And across the spectrum, State Bank of India on the one hand and UCO Bank on the other hand. And there are many others. They have their best quarterly results. They have done this, and industry also. And observers say that banks are in a pretty good health. NPAs have gone down. Fresh slippages are much less. Recovery is in full swing. And the bankers also learn their lessons from the 2016, that so-called asset quality review. They have gone through a lot of pain. Now everything is fine. We can only take off. That's the general perception, but there are critics, they said no, probably not. There are seeds are being sown because as you know, the credit offtake is a decadal high, but deposits are not growing that much. So there is a liquidity issue, there's an interest rate issue, there's an inflation issue. Reserve Bank of India has raised the rates from 4 to 5.9. Many believe that in December there will be also rate hike. Could it be 35 or 50? We don't know. But as we speak, the latest US inflation data, it's softer than what was expected. So the market has given a thumbs up. Rupee is now retracting. It crossed 83 and now it's 81, 50, 60. That kind of level is going today as we speak. 10-year bond yield is going down, which means so all are positive signs. Are they sustainable? What should India do? That's the kind of thing. Here I end my long monologue over. We'll only hear you. I will first state with a CRISIL person. Krishnan represent India's largest rating agency. So give us your perspective, the preliminary remarks, then we'll get into a specific thing. Where are we? Because the subject is, are they India financing institutions, are they adequate to support 8% growth?
So thank you, Tamalda. Very good afternoon to all of you here. And also thank the Trust Group for inviting me to participate in this very well-organized event. So coming to the question per se, and I agree that this is the most dangerous session through the day. People are just coming out of lunch, very important to keep you awake. I was actually suggesting to Tamal that if questions don't come, we will start asking questions to the audience, so just in a lighter vein. So coming back to the question per se, I think what is important is the various parts, segments of the financial markets in India to align themselves in the right direction for us to be able to support the 8% growth. I think the signs are there in segments like the banking space, the NBFC space, the credit markets are looking in a decent shape. What needs to come in is more traction in the bond markets. But let me come back to the credit markets. As Tamalda was saying, on the banking side, we seem to be in a proverbial sweet spot today. We are seeing credit growth picking up, NPAs coming down, capital being in a decent shape, profitability picking up. I'm reminded of, say, 5 years back, 2017-18, when the NPA problem was acute, largely for public sector banks. We used to have a saying then, many of you would have heard yesteryear's Bollywood actor Ajay, he's a villain. So he used to say, if you had to torture someone, you put him in liquid oxygen. So the liquid तुम्हें जीने नहीं देगा, oxygen तुम्हें मरने नहीं देगा. So you will be in between the two. So when we talked about public sector banks with high NPAs, we used to say that they are in that kind of a situation. NPA आपको जीने नहीं देगा, government आपको मरने नहीं देगा. But we have come out a long way since then. Government has given a lot of oxygen to the public sector banks. Around 3 lakh crore of capital has been infused. And today, every public sector bank has a tier 1 capital cushion of more than 100 basis points, which only 1/5 of the banks had 5 years back. So, and as I said earlier, the balance sheets look better. Even on the NBFC side, what we are seeing is there were 3 years of very subdued growth. We had the ILFS crisis happening. Then when things started improving, we had COVID hitting the sector. So we had 3 years of decadal low growth. But I think from second half of last fiscal, things have started to look up for the NBFC sector as well. This year we are expecting them also to register double-digit AUM growth. And one thing that is very important or heartening to see is whether it's banks or NBFCs, they have looked to strengthen their balance sheet by looking at the PLC framework. P stands for higher provisioning, L higher liquidity, C higher capitalization. So that is helping them move through an area where the asset quality could be under challenge or the credit growth could be low. So that's helped them to manage that situation. And two other things which I think are very important for the stability and solidity of the financial sector are good governance processes and good risk management. So if all these are in place, risk management, governance, and of course this LPC, that is liquidity, provisioning and capitalization, I think the foundation would be laid for the financial sector to kind of support the economy in the days to come. The other thing I talked about is on bond markets. They are still subdued. We need to see more depth and breadth in the bond markets to help increase the growth. One of the key things is that the bond market is not there below AA rating level. If that deepens, one of the angles could be that the investors are not clear as to what happens if there is a default, how much recovery we will get. So that could be one reason why they are sticking to AA and above. But let's see, with this IBC coming in over the next 5-6 years, if you have a greater track record on recovery, maybe that will make a delta, but, or if the credit default swap market picks up. But that's, I think, something which needs to improve for growth to be supported. But credit markets are in a reasonably good shape today.
Thanks, Krishnan. So we heard a rater. Now let's hear an NBFC. We'll start with some macro views, then we'll get into some specific issues, not about your company, but about the industry. So first, preliminary, Ramesh, over to you.
Thank you. Good afternoon, everyone. NBFCs have a specific role to play, and that's what all of us are ready for. I think the fundamental questions are NBFCs adequately capitalized to be able to participate and support the growth? I would think the answer is yes. Every NBFC is adequately capitalized and is all geared to participate in this growth. The other question is, how flexible are NBFC's model? Gone are days where you could create a very rigid model and say, I will only pursue this. And very clearly, we have seen actions around this from every NBFC, and models have become extremely flexible. And therefore, the capability of an NBFC to adapt itself to the changing needs are very clearly visible. I think the third is, how well do you understand the needs of the consumers, and therefore are you developing products which are asked for by the customer? And if you are willing to and you are able to do that, I think you will be an important player in the overall growth. And I can very clearly certify that. Look at the kind of products that NBFCs have launched over a period of time, and our ability to therefore service it to the consumer at their doorstep through different channel. That means the readiness of the channel for delivery of such credit and services. That's again a big readiness. And of course, it's a part of all of this in the sense of how do you respond to the needs of the regulator when you see regulations continuously asking you to do better than you were doing better. I think every business model should have a capability to be able to absorb the regulatory needs and then go to the next level. If you're going to question a regulatory requirement, which means the model is fundamentally not right. So instead of questioning the regulatory requirements, if you question your model and factor that in, I think you built a stronger model. And I would think this is what NBFCs have done over this period of time. And all NBFCs have seen different cycles at different points of time and have cleaned up the balance sheet over a period of time to make it even stronger. And put all this together, I think I'm extremely confident to believe and state that NBFCs are all ready to support the growth trajectory that we are all talking.
Thanks. Hold on, because I don't want two NBFCs coming together. So let's have a banker first. Inderjit, you are running an SFB, which has a very checkered history. Let's not get into that. I know you are building a digital bank, but we'll get into that thing later in the second round. Before that, give us, because you are in a very critical sector, you are supposed to lend money to the MSMEs and SMEs, even microfinance. So that's the other India, which, that K-shaped recovery has been talking about. India is growing, but Bharat is not growing. There are a lot of issues. And technically, you are in that Bharat space. So tell us that your community meaning the SFBs and others and all these intermediaries, have they geared up to support this 8% growth consistently?
Thank you. Thank you, Tamalda. Yes, I had the newest bank in India. Last 7 years, we're the only bank to have been set up by Reserve Bank. With a great responsibility. I was going through the McKinsey report, which said 6% GDP growth is not sufficient for India. Our growing youth, aspirations of our youth, need more employment than that. I was in Delhi the other week, and Vice Chairman of Niti Aayog, Mr. Rajiv Kumar, said at 8%, India will double its economy in the next 8 years. To me, both are very encouraging figures. It tells us in which direction all of us in India have to focus. 6 is not enough. 8 is just break even. We have to do something like pulling a rabbit out of the hat. In my case, the turban. So, we broke this down. What does it mean? For our agricultural sector, which is sustenance, we have to grow at minimum 4% so that we don't have a hole. Our industry, minimum number set is 10%. I was at the Mind Summit in Delhi. Finance Minister used the term Hanuman. She egged Indian industry to invest in India, where everyone else is investing, but the local industry is not. She said, even Hanuman needed encouragement to carry the mountain to Lanka with the magical booty. Finance Minister said, I'll be your Hanuman and support the industry as required. So basically, everything is in place. The challenge and the gauntlet has to be taken up. What Tamalda said is that India is just not India. It is not metros. It is Bharat. There are different segments of financial inclusion which reaches Bharat. My bank is one of those instruments. 75% of my business is to get the supply chain, the MSME, microfinance included. It is not just a responsibility, it's an opportunity. Tamalda also said, we will not be another bank. The plan is to go digital. India leads digital space in the world. Why do we not lead it in India itself? We have to believe in it. So in the second round, when it comes, I'll tell you how digital banking is actually going to make a difference, reduce the acquisition cost, deliver better, faster, with more efficiency to our people.
Okay.
And that's how we'll take it ahead.
Thanks, Indrajit. So you said that all the financial intermediaries are the Hanumans. Is that correct? Achha.
Absolutely, sir.
So give him a big hand. No, actually, it's a very, very nice, very different way of looking at things. Nilesh, hold on. I know whatever you want to say, you will say. But being you are representing the investment community, right? The investors. So we'll hear you the last. And do you demolish all their arguments, or do you see in a different way?
Investors always have the last word.
But before that, we'll have Jairam. He's also represents NBFC with a housing finance focus. So tell us preliminary remarks, and then we'll get into some specific one or two issues. Different persons will have different issues.
Sure. Thank
and
you.
we'll take questions after Nilesh talks. Anybody has any question, just please raise your hand and ask. Yeah.
Thank you for having me. Let me start with two quick facts. Fact number one, the fastest growing economy, large economy in recent times, China, grew largely on the back of credit. You might argue that whether it was a good thing or not, but the fact of the matter is that when credit penetration in China grew, the economy grew massively. Fact number two, Indian credit market today is at 15+% growing at the fastest rate that it has in the last decade. There is no large economy in the world that can claim anything close to that. So it is clear that from the credit market functioning perspective, right now, for various reasons, we seem to be in some sort of a sweet spot. And that sweet spot is necessary if the country is meant to grow at 8% plus on a sustained basis. Credit growth is an imperative, and credit growth seems to be coming. If you look at how credit growth happens and how that becomes the fuel for economy, savings have to happen at the ground level, and financial intermediaries need to be there who are able to gather up that saving and give it to the right party. Today, the financial intermediaries, people who gather up that savings, are in about the best financial health they have been in a long, long time. Krishnan spoke a little bit about provisions, about capital levels, and about liquidity. On all three fronts, financial intermediaries today in the country are about the strongest they have been, probably in the last 20 years. So really strong financial institutions. Borrowers on the wholesale or corporate side are also about as delevered that they have ever been in recent times, which means that intermediation process can happen actually quite nicely. The problem, if any, in my mind, is whether there is enough stuff to intermediate. The raw material, which is the savings, which is the starting of the entire process. Do we have enough of that? You can have lots of intermediation and intermediation happening great, but if the raw material isn't there, this isn't going to cut it. So the question is, the savings in the economy, which is going to get funneled up to drive lots of economic growth, is there enough of it? And if there isn't, the question to be asked is there some need for us to think about opening up the doors a little bit for foreign sources of capital to come in and start fueling the growth? You can have in the same intermediation institutions, but sources of capital outside of the country as well. Now, Nilesh bhai, represents an industry which funnels a lot of the savings from the ground level into various sectors. I'm sure he'll have a lot of views on this. Would love to hear those as well.
Thanks, Jairam. So, growth is, there is no question on growth picking up, but how do you support this? Liquidity, in other senses, the raw material is money. There's not enough domestic savings, so do we need to open windows and who the foreign money? That's what you're saying.
And India used to be an economy in which domestic savings were global highs, right? We used to have the highest savings rates in the world. In recent years, that has tapered. It's not super clear why that has tapered. Some of it has got to do with the pandemic, and there are other reasons as well. But savings have tapered. That is an important question for us to ask, right? If savings go down, fundamentally, where is the raw material from where, which is going to get funneled up for investment purposes, for institutions, companies, and the government for investments to be made and growth to happen?
We'll hear Nilesh bhai. So the bonus is on you. You are the atlas on your कंधे पे हम लोग को अभी बोलिए क्या बोलना है. Incidentally, you spoke about where's the money gone and all. The currency in circulation, which is largely you and me, what keep the cash in this thing at home with us, is sort of historic high at this point of time. This is 3.5 times, if I'm not mistaken, more than what happened in early 2017, just after demonetization. It's, I think, 35 trillion odd, if I'm not mistaken, around that kind of number now, which of course includes the bank branches which keep the little money with them, but largely with public, and it's typically for festive seasons and during elections it always goes up. Anyway, that's just an input. Nilesh, from an investor, sitting on investors' parts, and after that we'll take up 1 or 2 questions, then we'll go back to some micro issues. Give us your sense what's happening.
Thank you, Tamal. If you look at today's Maharashtra, it is at the same level as India was in 2005. So today's Maharashtra GDP is equivalent to GDP of whole of India in 2005. If you look at Uttar Pradesh and Uttarakhand, they are at 2001 India level. And in those days, Uttarakhand and UP were together. And then there are 3 states, Gujarat, Tamil Nadu, Karnataka, who are at 2000 India level. In about 15, 20 odd years, these states have become as big as those days India. Fair to say that over next 15, 20 years, this state will become as big as today's India. So growth is possible. Now, many states want to reach $1 trillion GDP and $2 trillion and $3 trillion. But that requires money. Without investment, growth cannot happen. Now, investments will come from 2 parts, domestic savings or global capital. When I started my career in debt market, number of players were people sitting on this stage. And today when I see this hall being filled, I have no doubt that domestic savings will be good enough to support our growth. On to the foreigner side, I was making presentation to someone who manages a couple of $100 billion. And honestly, I said that, sir, India is expensive on a one-year basis. We used to trade at 40% premium to our emerging market peers. Today, we are at 86%. This is the guy from whom I wanted to grab money. And he tells me, Nilesh bhai, nazariya badaliye. You might be expensive on a one-year basis, but you are the cheapest emerging market on a 5-year basis. So please talk about 5-year valuation, not 1-year valuation. Earlier, if we wanted to raise money from foreigners, we were to travel to their countries, their place. Nowadays, every 10th day, we are seeing one visitor here. So there's no point in traveling, might as well be based in India and collect money. Globally, will capital come to India? Undoubtedly, yes. We are the only country which is providing 3G. One, growth. Our earnings growth will make us cheaper on a medium to long-term basis. Second, governance. In our country, you can take money out, no questions asked. Try doing that in China, you will realize. In our countries, you can criticize government. Try doing that in Russia. 8 businessmen have died in suspicious manner because they criticize Ukraine invasion. In Mumbai, you can travel at 12 in the night. Try doing that in South Africa and you will get mugged. So from a governance point of view, there is no country capable or comparable to India. And finally, we are giving green return. We are the only country which is on its way to achieve COP26 commitment or Paris Accord commitment. Others have not even signed for it. So green growth and governance, will we be able to get foreign capital? Answer is yes. And God forbid, if domestic capital and foreign capital is short, then we can always rely upon our gold holdings. In first 21 years of this century, Indians have imported on a net basis about $373 billion of gold. If we look at the gold seized at Customs Department and assume that smugglers are not charitable organization, our annualized gold smuggling is $7 billion a year. This is based on last 3 years average golding seized at Customs Department. So effectively in 21 odd years, we would have sent $500 billion abroad for import of gold. Isme silver, diamond, pearl, add karo to you know where you are. So if capital doesn't come to us from domestic and foreign sources, then we'll have to monetize gold. There's only one challenge which I see. A lot of Indians are thinking of moving abroad for quality of life. Dubai, Singapore are becoming destinations. And many of them are taking their capital also along with them. We need to ensure that that capital stays here. If you want to go and settle in Dubai, it's fine. But leave your money behind. We should not give free exit to that. Subject to that, money is available for right growth.
Okay, thanks Nilesh bhai. Lot of interesting facts with ease you could say, and going beyond finance, he has also got into socio-political issues and says that time is ripe for India to take a leapfrog into the next orbit. Any question anybody has? Otherwise, we'll get into some specific issues. No? Where? Can this person have the... Yeah, just make it very brief. Introduce yourself and make it very brief. And to whom you are asking. Yeah, thank you.
Yeah, this is Ankit here from Piramal Capital. My question is to Jairam, sir. So, sir, 8% growth is something that we can achieve, of course, but what can we do to ensure that this 8% growth is equitable and secular? The last man standing in the line actually gets the benefit of this 8% growth and the entire country actually grows. What is the role of financial institution in this?
See, that's a great question. That's a great question. It is the inequality in both wealth and income creation over the last 40, 50 years has of course been extremely high. That said, if you look at the Gini of India, which represents the total inequality in the in the economy, and you compare it with Gini across many of the developed countries, we are not great, but we are not terrible. There is, of course, a whole lot of inequality here, but to take off from a point that Nilesh bhai made around in his comments, over the last 20 years, even the sort of bottommost part of the Indian citizenry has actually gone up in absolute terms quite significantly. Gini hasn't moved. It's not like India's Gini coefficient is getting worse every year. That has not actually been the case. It makes for eye-popping statistics to say that, okay, top 10 people in the country have as much wealth as the bottom 20% or whatever it is. Like, all that stuff is really scary to listen to. But the fact of the matter is that, country as a whole, Gini hasn't actually, deteriorated. The challenge that we have as financial institutions is, within the country, are we doing enough to operate in every part of the country and bring every part up? For instance, NHB, our regulator as housing finance companies, we had a meeting the other day where the NHB chairman asked me a point-blank question: what are you doing in the Northeast? What are you doing in Kashmir? I really couldn't say hand over heart that I was doing anything meaningful. So we as financial institutions have got to be in tune with what some of the national agendas are. And if some of the national agenda around inequality lies around being present in every part of the country and genuinely doing business there, not just ticking some box, then we've got to play our role and make sure that we are doing something meaningful there in terms of incremental investments.
Thanks, Jairam. I hope that you have not taught him to ask the question. You're from the same company and you said it's a great question. Anybody else? Otherwise, we'll shift. Other shift back. No? Is there any other person? No. So this gentleman, yeah. Then I will just make it like very brief.
Hi, this is Manoj from State Bank of India.
Oh, not from Mahindra, so it's okay, fine. Tell us.
So I just want to understand what is let us hypothetically assume that the present financial institutions are adequate to support. Where can we go wrong? What is the downside risk to our hypothesis that the present financial institutions are able to support this growth?
Okay. I think, Rater, we can answer this. Make it brief, just.
Yeah, I think very pertinent question. where financial institutions are in a high growth environment, what is very important is how they are tracking on risk management and governance. If you look at the last, say, 5 years, decade or so, most of the failures you will see in the financial sector are due to governance only. It is not due to any major fundamental mistakes in the business side. Maybe one or two may be there, but by and large, it is due to governance. So I think it's very important to ensure governance in the right space. Risk management should be up there. And if you get down to brass tacks, today it is, if I look at the banking sector, credit growth is tracking at 17+%. Deposit growth is at 9.5%. So far, the banking sector has been able to run at higher credit growth last few quarters because of the buildup of liquidity, which was there earlier. From the time of the pandemic till, say, maybe 2 years, the deposit growth was running higher than credit growth. So they were building up, that liquidity had built up. So now they've more or less used up that liquidity. It is normalizing. Deposit rates need to pick up so as to maintain the credit growth. So that's another angle we need to look at. The other thing is in certain segments, the population has not yet fully recovered from the effect of the pandemic. It is, again, going back to the K-shaped recovery. Some of the MSMEs, some of the retail segment in the lower end of the socio-economic strata, yes, improvements are there. So they are still not fully back to pre-COVID levels. So I think the faster they come back, the better it will be for a all-inclusive kind of a growth.
Thanks, Krishnan. So I again trust you have not only got a right kind of panel, also you have got the right audience. They're all asking lovely questions, right? So no more. We'll time permitting, and if you're willing, anybody will probably take one question later. But before that, let's get into some micro issues, and each of you will have different thing. We'll start with you, Indrajit. Particularly post-COVID, the banking segment is doing so well. That's a separate story, but it's under threat, the traditional banking from the so-called fintech and tech fins. So it's sort of existential crisis for many banks. Can you just tell us what exactly happening in that space? Like all the banks now need to be run by techies, or what's happening? And what's happening in your bank? You claim to be the first digital bank in India. At least you strive to become. So quickly, a few minutes, if you can tell us, what's the future of banking?
Sure. Thank you, Tamal. Before I launch into that specific space, I was in a workshop with a bunch of people who are a little more intelligent than me, trying to figure out, this was in the US, trying to figure out what are the risks, what are the two main risks facing financial institutions in the world. Two main risks. 173 countries in that forum. It was agreed that the largest risk the bank faces, banks in the world face, is its reliance on internet, on cloud, on shared services. Essentially, if the net were to go down today, I mean, not only Zomato and Swiggy will stop, a lot of things on earth are going to stop. And most financial institutions do not have a control over these things. That, we decided, was the largest risk facing humanity today. The second largest risk to put up was what we defined as large-scale disruption. The first disruption which comes up is supply chain. What the shutdown of China has meant to various industries in the world. Included in that are pandemics, what COVID has done to the world. So these two, internet and large-scale disruptions. Coming back home, we are fleshing out the new era of financial institutions in India. The first era, if I can humbly set up, is post-91 till now. In this 30 years, from 90s to 2020s, India has grown at an average GDP of 6.5%. In the first 40 years, from 1951, where we have data, up to 91, we had grown at 3.5% of GDP. 3.5 has almost doubled to 6.5. Aspirationally, India wants to be 8+. As such, every system has to fire. Each one, State Bank is given its role, NABARD and SEDBI are given their roles, NBFCs are given their roles, financial institutions are given their roles. But it is not what we do, it is how we do it. Gentleman asked about including the last man in the line in finance. The way to do it is actually digital acquisition, digital servicing, and digital completion. That's our strength. All of us in this room have to think digital now. For the longest of time, as a banker, I had forgotten what digital meant, but had to relearn, and all of us have to relearn and make it a part of a system. It's only then that we can reach the unbanked markets, and that's where the entrepreneurship of India will come. That's where the wheels of economy will chug. That's where the garages will breed new innovations for us. It's our collective duty to actually deliver on that.
Thanks, Indrajit. So let's ask between the two, maybe Ramesh, you tell us that this is the technology is one aspect. This is also the new era of collaborations. I mean, we can call it in different way: co-lending, collaboration, last mile connectivity, etc. Do you see that that's the way forward, both for banks and non-banks? I mean, you can't do everything. So it's a series of collaborations and all. It's basically not competition, but coexistence. Sharing each other's expertise, like you need to shake hands with some techies, I mean the fintechs, and then get into rural India for your affordable housing, etc., which you don't have the expertise now. Is this the way forward actually for the India growth story? That's the way the financial sector will evolve?
So I think the clear answer is yes. How many things can we do ourselves if we want to really play a game of scale? Right? As a small company, you could do everything yourself, keep it close to your heart. I think gone are those days. I think we shouldn't even look at competition as competition. I mean, look at co-lending is one step in that direction. If today the discussion is about can an NBFC and bank work together, at some stage the discussion was, are we competing with each other? Today we are saying, can we work with each other? And likewise, I think all business models have to decide what is core to them and what else can be then outsourced or partnered with. And what that helps, it helps one, super efficiency because you are not as good at that, but someone else is far superior. So one, it helps super efficiency. Second is it helps cost. For someone, if it is a core, is always most competitive in terms of pricing. And you try to do that, you're never going to be competitive. So therefore, that's the other reason why you need to do. I think the third is, if you do it all by yourself, you prioritize and you do few things good and few things you just, chalta hai attitude comes in, whether we like it or not. And that drops the efficiency or the experience to a customer. I mean, you look at it from manufacturing side, they were always partnering, right? The components were being outsourced. You take an auto company, they were only doing the engines by themselves. They never manufactured tires, they never manufactured seats. They always bought it from someone and they got the best. I think this is coming to the service industry, the financial services industry. So I think clearly we will have to collaborate. I mean, you can see this as a very clear moment even within organizations. Earlier, each of the function was not very easily collaborating with each other. Today, if you kind of look at any organization, everyone understands that we have to be a strategic partner to each other. And I think this is an attitude change, I would think, and this is forced by none other than the ask of a customer. We somehow think that it's a regulator who's trying to bring this change or competition is trying to drive us towards this change. My personal understanding is it's the consumer who's been continuously telling you, my dear friend, your product is not right, your price is not right, your delivery channel is not right, your service standards are not right. And then we have looked back and said, oh, if that's what his ask is, how do I achieve it? And that's got us to think that let me use the best in the market and then package it to provide the best. So my simple answer is collaboration and partnering with customer is going to bring the best out of you and your model, and that's going to give the best to the consumer and the value for money for us to really succeed.
Partnership. Partnership, that's all. Jairam, yeah. And this time I'm getting two NBFCs one after another because the subject is different. Tell us, is there any, what is the future for NBFCs? I may sound very rude, but after this, Reserve Bank of India introduced the scale-based regulation. So you are actually on a par when it comes to recognition of bad assets and many other things, and there is not much of difference between a bank and NBFC. But you can't raise deposits, like the banks have that. So is the way forward for NBFCs is to strive to become a bank? Is this the way forward? Or no, you think that there is space for NBFC, it can continue and flourish, and then if that is the case, then what is the right model?
If you look at the lending sector in India over the last 30 years, you will find that in product segment after product segment, it is some sort of an NBFC that has first innovated on a product category, gotten it to a point where it has become scalable and it is profitable and it is reasonably large, and then banks come in and essentially take that and grow it in a really big way. This is what we saw happen in, of course, housing with HDFC Limited. We saw it in car finance, which was essentially an NBFC business. We saw it in gold. We saw it in microfinance. Every product category you look at, NBFCs have innovated and created the products. They have gone from 0 to 1 and 1 to 100. And beyond that point, going from 100 to 1,000, banks have come in. And a proven business model, banks have taken and actually scaled. That idea, I do not think has lost its relevance. So some set of players who are innovating on the margin and trying to come up with new consumer needs which can be productized and new segments that can be created and scaled, that need, I think, will continue, and NBFCs will continue to play that role. However, the era where those same NBFCs got bigger and bigger and bigger and essentially aspired to become almost as large as the few banks in the country, etc. I think that era is probably coming to a close with scale-based regulations, etc. That you referred to. This idea that some of us, Ramesh runs a really large NBFC as well. So some of us might aspire to say, I will become a 1.5 lakh crore balance sheet or 2 lakh crore balance sheet and continue to remain an NBFC. I don't know whether that's possible anymore. There are one or two examples, of course, now in the market between Bajaj and HDFC Limited and the new Shriram as they get created. These really large behemoth institutions exist, but I think those are becoming historical accidents. And I don't know whether you will see another one of us getting to that scale without going down the public deposits route and hence a banking license.
And HDFC is being merged to the bank.
Yes, of course.
Right? Yes, you wanted to add a little bit?
Just wanted to add a quick comment. Till such time NBFCs remain unique, there is always a role to play, right? You shouldn't get yourself normalized out there. Second is, if you know whom to give, when to give, how to give and how to recover back, it doesn't matter the regulatory frameworks are bridging. I think this is the uniqueness of the NBFC model which has allowed them to survive, and we have been asked this question every 5 years. And I've heard it last 5-6 times. I think we have to reinvent at every stage to remain if you decide to remain an NBFC.
Okay, thanks. We'll end at 3:10, so we have about 8 minutes left. So both of you, Nilesh, again, just because my question is as such, you need to come at the end. So he always has the last word, you can see that, because of his purchase from the market as an investor. So before that, Krishnan, tell us about this, the banking story. I mean, there are cynics who says, no, yes, bank balance sheets are pretty strong. Look at the PCR, that is provision coverage ratio is very high, etc., etc. But they're saying, no, there are issues like the loans being restructured. Some portion of it will turn bad. We need to wait for that. And second is the new exuberance. I'll not call it irrational, but giving loans, there again banks are following the same, some banks following the same hard mentality, balance sheet growth, seizing the opportunity. They were like Kumbhakarna, they were sleeping for the last 5 years for multiple reasons. Now suddenly they woke up and they want to gobble up everything. So there are seeds being sown for future NPAs. And already the restructured assets are there, which can turn bad. So we need to wait and watch. And as someone says that when the tide goes out, those who are swimming naked will be exposed. So a few years down the line, we'll see some banks naked. Is that the right assessment? And if you want to say anything, a few minutes, and then I'll come to the last question.
Yeah, so these are cycles. So historically, if you see NPAs go up for a few years, then they start coming down. Today, we are in the process of a down cycle. We still believe there is some more way for NPAs to come down. March 18, banking sector was at 11.2% NPA. March 22, we are at 5.9. We expect that to come down to 5% and further down to 4%, and maybe a little more before it starts moving up. So when there is a risk-off scenario, everybody is overcautious, everybody is conservative, and that also pulls down growth. When there is a risk-on scenario, we are getting in that situation today, sometimes caution gets thrown to the wind, and people may become overly exuberant, and that could sow the seeds for either, again, asset quality deterioration in the days to come. But I think structurally, we are moving towards a phase of better risk management over time. So while the cycles could be there, but the amplitude of that cycle is coming down. So if I go back to the mid-90s, peak NPAs were at 25%. So 1/4 of the book was NPA in the banking sector. Now the peak NPA is 11.2%. So it's more than halved. I agree that there is restructuring, but overall restructuring is still around the 2% mark. It's not a very high level. Yes, MSME segment, it is around 6%, but large corporate sub 1%, retail 1.8, 2%. So it's not so high. So I think while yes, there are cycles, and we may in the days to come again start seeing NPAs go up, but the key is to keep the balance sheet strong, have good capital, liquidity, provisioning. And I just like that one line on the NBFC side. There again, I think we do believe that there is always a space for NBFCs. Some of the skill sets that NBFCs bring to the table, customer relationships, adaptability, local knowledge, innovativeness, responsiveness, last mile connect. These are things which banking sector does not come naturally to the banking sector. So thanks. NBFCs will be there. The way forward could be a partnership, collaboration, asset-light model of growth or an AUM growth. But NBFCs will, we believe, still continue to be there and more innovative. We actually, 20 years back, had come up with a model called the WIFP model, VIFP. So NBFCs come and start virgin products or geography segments. They are the innovators. That's what I stands for. F, once that segment grows, banks come in as followers. And then P is it becomes partners. Both of them become partners. So okay. That I think is beginning to play out now. Yeah.
Thanks, Krishnan. Nilesh bhai, we are about 3 weeks away from next RBI policy, December policy. Meanwhile, what happened is till recently, the perception was that US Fed was going 75 bips and all, but it will be reversed soon. But now the thinking is this, no, it will take a while to reverse, but the next hike will definitely not be 75 bips. And the latest inflation number is this. And in that context also, some people believe that India has done enough because our nature of inflation, character of inflation is very different. RBI should not be very aggressive anymore. But on the other hand, you see the negative interest rate, you are talking about saving community. I mean, why would they keep money with banks? Because if inflation is 7% and I'm getting this. Till recently, bank was pretty miserly in their approach to the depositors. So tell us, what do you expect from had you been the RBI governor, I am sure there is no RBI person here, so you can play the role. What would you do in December?
So I will just expect from RBI to say, "Main hoon na. I'll manage everything. Don't worry. Be happy."
Just don't be diplomatic. If everybody, he is saying it's a cycle, I mean, these are all, there's no election in Maharashtra, nothing. So let's not be diplomatic and politically correct. So tell us, they want to know, the investors community want to know, what do you expect? What does the market expect from the regulator?
So till yesterday...
Forget, you are not RBI, you are Nilesh Shah.
Till yesterday, I thought our terminal repo rate was somewhere around 6.5%, plus or minus 25 basis point. Post yesterday night's US inflation number, I believe there is a reasonable chance for repo rate to be between 6.25 and 6.5. We will continue to raise rates in tandem with Fed, but albeit in a much smaller quantum. And we'll wait for Fed to take a U-turn before we'll start cutting. It makes sense to follow the Fed rather than be ahead of them.
So 5.9, so what would be the rate hike you were expecting in December?
So December, about 25 basis point.
Actually, not even 35.
I mean, we have luxury of keeping it down.
Okay.
But, again in US Fed, they walk left and talk right. So when they issue press release, it is dovish. It satisfies one set of listeners. Then when Jeremy Powell come to the press conference, I don't know what does he drink, but then he goes exactly opposite to press release. So in this press conference, he said, the terminal Fed rate is not 4.63, but it will be higher, could be 5 also. That press release didn't mention that. Second, he said rates will remain higher for longer. The press release was indicating as if they are going to probably stop raising rates and may look at cutting rates, but in press conference he said, be ready for higher for longer. And third, if those two statements were not good enough, he came and put a bomb saying that there are two kinds of mistakes I can make, type 1 and type 2. In first mistake, I will raise interest rates beyond necessary, and that will create recession. In the second, I will not raise interest rates enough, and that will create inflation. I'll rather make the mistake of type 1, raising interest rates beyond necessary, because I can always cut it quickly. Now, what do you look at? Press release, press conference? I think Jeremy Powell himself is confused, so it's better to stay behind him rather than ahead of him.
Thanks, Nilesh. So we are just on time, 3:10. So quickly, 30-second thing. So India is a sweet spot. It's a great story. Great to be in here. Growth will be sustained. Our financial system is robust. That's what the rater says. Nilesh, from a market perspective, says no, there won't be any problem on liquidity. There will be enough savings. Indrajit from banking side says technology is the way forward. All the banks will behave like tech companies. There will be digital banks. And the two NBFC says that cooperation and partnership is the way forward, and every NBFC does not need to become a bank. As long as their USP, their business model is right, they can survive and flourish. So the financial system is robust, is sound, and in the best of health. In fact, Mr. Kamath said that he has never seen, some time back he made that, before this quarterly results, before both the June quarter and September quarter results, I think 6 months back he had said that the banking sector is never been so strong in the past 50 years. So it's strong enough to support the 8% growth. Thank you, Trust. Thank you, everybody. And if you like them, so give them a big hand, please.
Thank you, Tamal ji, for playing the devil's advocate. In fact, I want to state this to Nilesh ji, that I'm one of those candidates who are planning to actually move to Dubai with my family. But I will try and keep all my funds in India, yeah, and not take it to Dubai. Maximum money here, right? All right. Okay, with that, ladies and gentlemen, I'm going to invite on stage Mr. Anand Jami, the Associate Director, Trust Group, to please step forward. Along with Mr. Parag Kutari, the Associate Director, Trust Group for the Momento. would first unveil the compendium on Indian financing institutions. Gentlemen, let's have a round of applause for our panelists. What a knowledge-packed session. And with that, I would request Ji to hand over the mementos to Mr. Ramesh Iyer. Mr. Ramesh Iyer. Followed by Mr. Nilesh Shah. Next, Jairam ji. Inderjeet Kamotra. Next, we have Mr. Krishnan Sitaraman. And let's have a group picture together once again. A quick group picture. Panelists, and I would request Tamal ji to remain on stage for our next segment. Tamal ji, request you to remain on stage.